Welcome back to the 90s podcast hosted by yours truly, Kevin Thompson, founder and CEO of 99 Capital Group. Thank you guys for joining me. As I always say, subscribe to the channel. As I always say, go and get my book, MLB to CFP, live on Apple and Amazon. If you have any questions, comments, or concerns, you can email us at info@99capitalgroup.com. Send us your questions. Go to the website at www.99capitalgroup.com. Schedule your appointment. As you know, we're here to do what? Educate, empower, engage, and also entertain. Follow us on all social media channels at 99cap or at MLB to CFP. Also, new Substack. Follow us on the Now What channel. Thank you guys for listening. So today we are talking about the hidden tax traps inside your 401k. We had some pretty good feedback on our previous episode about 401k. So we wanted to bring a little bit more insight to the 401k landscape because there are a lot of questions. So without further ado, let's get it. So again, welcome back. Today we're breaking down some of the most overlooked tax traps inside the 401k. These aren't investment tax traps. These are more IRS-driven structural traps, and they're the traps no one explains to you until it's too late. So I want to kind of go into a couple of different things because, again, as an EA, I can have these conversations. Most CFPs right now are not having these conversations because it's considered tax advice, and we are here talking about things that can possibly get people in trouble. But since I'm an enrolled agent, I can have these conversations. Again, later in the show, I'll be going through a real life scenario where a tax professional who completely butchered a Form 8606 basis in an IRA and what it means for the client. This is really going to be powerful. So let's jump in. So first and foremost, your 401k is not just a retirement plan. It's a tax plan. Every time someone mentions your 401k or a qualified plan like an IRA or HSA or something like that, they are impacting your taxes. For them to say that's tax planning versus tax advice is laughable. Laughable. People think their 401k is just a savings account with a match. No. A 401k is a tax strategy. The IRS lets you save for 30 to 40 years inside this account, and then they come back for their share. Everything you do in that account, contributions, rollovers, withdrawals, has a tax consequence. And the biggest tax mistake I see aren't investment related. They're contribution mistakes, rollover mistakes, basis mistakes, which we'll get into here in a second, RMD mistakes, filing mistakes, spousal mistakes. I cannot tell you how often I see an individual who's been divorced for 10 years who goes back into their old 401k and sees their ex-spouse still on the account as the beneficiary. If taxes aren't part of the retirement conversation, I will say this time and time again, you're already behind. So let's talk about trap number one. Pre-tax contributions can hurt you later. So this is a huge blind spot, the pre-tax contribution. Yes, we get a deduction today. This is great. We're reducing our taxable income, not our taxable income. We're reducing our adjusted gross income. Boom, right off the above the line. Yes, it reduces the taxable income that we currently have. This is great. But always remember, there is no free lunch in this game. It feels good, but you're not avoiding taxation. You're just delaying it. And delaying tax without understanding the rules is absolutely dangerous. First, let's talk about the Trump tax cuts. Now, we know that they were just extended, so that's good, right? Some of them permanent. But here's the real trap. Let's look at the enhanced senior deduction. That's a temporary deduction, which is only going to last a few years. And that deduction matters more than you think, especially if you're over 65. If you're over 65 and single, you get roughly a $6,000 enhanced deduction. Over 65 and married, roughly $12,000 if you're under some income limits. But that enhancement is not a permanent law. It is temporary, and depending on your income, it may not apply at all. Right now, some retirees may be paying 0% on their IRA withdrawals because of the enhanced deduction and the increased standard deduction and the enhanced senior deductions. I mean, it's a powerful thing when you add in Social Security taxation and all that. Sometimes in this situation, your IRA may be getting taxed very, very limited, if at all. There's a huge cushion there. But when that temporary enhancement ends, that cushion disappears, meaning your future IRA 401k withdrawals may suddenly become taxable. Your Social Security may become taxable. Your Medicare premiums may become taxable. Your Roth conversion window shrinks. So the trap is clear. You saved tax today based on the rules that may not exist tomorrow, but your tax liability is permanent. This is why pre-tax versus Roth decisions are changing. It's valuable to have these conversations now because that deduction is going away, or it may go away depending if they make it permanent or not, which I doubt they will. The math is very different right now. So now let's go to section 3, which is the trap. RMDs will own you if you ignore them. RMDs, required minimum distributions, are the IRS saying, hey, I let you defer. You've deferred long enough. Now it's time to pay up. RMDs don't just add income. They create secondary tax problems. Higher Medicare premiums, perhaps. Higher Social Security taxation for sure. Higher capital gains tax, if applicable. Loss of ACA subsidies, pushing you into higher tax brackets. This problem isn't the distribution itself. It's the tax bracket pressure the distribution creates. If you wait until 73 to figure this out, you've already lost the battle. It's important that you understand what the RMD is going to do to you in the future, how it's going to impact you in the future, and especially if you are a married couple, how a dual RMD will force you guys into a higher tax bracket if applicable. It's important. If you're not doing the RMD planning today, I don't care what age you are, if you're not doing the RMD planning today to figure out, hey, this is the probability of our taxes in the future, maybe we should start doing something different. Maybe we start converting dollars today. Then what is your advisor doing for you? Now, this is trap number 3, the after-tax 401k rollover disaster. This is something when people leave a job, they assume a rollover is very simple. Most 401ks have pre-tax money, Roth money, after-tax contributions, employer contributions, company matches, sometimes employer stock. If you do these things the wrong way, it could be an absolute disaster. You get double taxed, your basis gets corrupted, your 1099 gets misreported, you lose Roth opportunities, you owe taxes you never saw coming. And this leads perfectly into this real world scenario, the 8606 scenario that has absolutely been a disaster. So I have a real story about 8606 basis that may cost someone thousands of dollars. So let me walk you through something that I'm dealing with right now. A client came in with their tax return. I look over it and I notice there's 8606 basis, which means that there's basis in their qualified accounts, which means that the assumption from the CPA is, oh, they made qualified non-deductible contributions into their qualified accounts previously while they were working, or it was a possible conversion at some point. Whatever the case may be, there was non-deductible contributions made at some point in the future or in the past that designates that there's some basis in these IRAs. But guess what? The clients never never made non-deductible contributions. They're not aware of those. Well, guess what else? The CPA is no longer in business, and now the CPA sold his book to someone else. But guess what? If you can't substantiate basis doesn't exist. The IRS does not care. So what is this telling you? This is telling you that 8606 basis, when we're having these conversations, when you do non-deductible contributions inside of your 401k, those non-deductible contributions will be reported separately within that account. So when you make non-deductible contributions inside your 401k, if and so, either A, those contributions are going to be considered Roth, or those non-deductible contributions will possibly be commingled, but there will be a record of those non-deductible contributions. So when the account's rolled over, you may be able to push those non-deductible contributions into another account to separate those accounts, or there's going to be considered 8606 basis, where that basis amount will count towards a basis amount. So when you start taking contributions or start taking distributions, those distributions will come off basis as well. But the issue here is that there is no record of basis. It's just the basis number just pops up. So by going back and doing the research, we still are working on this case, and we're still working to figure out what happened in this case. Because again, multiple mistakes were made, whether it's 2020 misreportings, whether it was 2023 incorrect reportings. I have found a number of mistakes. And that's the difference between having a CPA, a true CPA, and just a regular tax professional. Right now we're dealing with just a regular tax professional. Again, nothing against anyone who's doing the business, because I respect everybody in this industry. But we want to have people that are licensed to do these types of things, like an EA or a CPA or a tax attorney. Now, again, this mistake is not simple. It's not a small mistake. This is a multi-year, multi-IRS problem. Here's what this really means. The IRS may force us to amend several years of taxes. They may owe penalties. They may owe tax they didn't plan for. Their basis may be reset. Their RMD calculations may be wrong. Their withholdings may be wrong. And the big kicker, the IRS doesn't care. Like I said, if you inherited a CPA file, they don't care that your old CPA retired. If it's wrong, it's your problem. It's the problem of the current tax professional and the clients. This is why I push so hard with working with a tax-centric planning firm. The investments didn't cause this. The paperwork did. This is a hidden trap of the 401k and the IRS system. Another trap, rolling over the wrong money at the wrong time. Rolling money over is not a one-step decision. You have to consider employer stock, after-tax dollars, Roth buckets, outstanding loans, the CARES Act distributions, pending RMDs, spousal accounts. You can end up triggering entirely unnecessary tax bills simply by rolling over money at the wrong time or in the wrong sequence. I've seen people lose $20,000 to $50,000 from rolling over with a rollover mistake. A rollover mistake would be, hey, by the way, the check comes to me personally, and I don't put it into a qualified account within 60 days. That's a 60-day rollover issue. Or, hey, they make the check directly out to you, and they take their 20% withholding. Oh, my God, why did I do that? So it's important to understand rolling over money the correct way is very, very powerful, and custodian to custodian is the best way to do it. But, again, it also depends on how the dollars are combined, what's inside the account. Are you going to roll over at employer stock, or are you going to use what we call net unrealized appreciation and be able to maximize that employer stock and get capital gains treatment on some of those dollars as well? It's all important to have these conversations because doing it the right way matters. One of the biggest traps I see is the widow's penalty. This is a trap nobody warns your family about. When one spouse passes away, the survivor keeps the income, keeps the RMDs, keeps the Social Security distributions, keeps all of the RMD distributions and other assets. Typically, the income falls by one Social Security amount. But what happens here is this: the single tax bracket basically destroys that widow. Yes, not in the first year because you're still allowed to file married and filing jointly, but after that, boom, it's an issue. It's an issue, or qualifying, whatever. It's an issue. So I've seen it, and I'm going to continue to see it. Typically, the wife is the one that's left. Again, same income, tighter brackets, higher taxes. This is called the widow's penalty, and it destroys people financially if we don't plan for it early. Okay, Kevin, you talked to us a little bit about everything. So what can we do about it? The good news is most of these traps are avoidable with the right planning. Review your 1040 every year. If your advisor never asks you for it, that's a problem. 2, understand your 8606. If you don't know your basis, the IRS won't either. So make sure if you are adding non-deductible contributions to your 401k, make sure that is noted somewhere and make sure that your record keeping is accurate. 3, plan for RMDs early, not at 73. You can smooth out taxes by starting in your 50s and 60s just by seeing exactly what's going to happen in your current environment. And of course, once you retire, you can possibly start doing some Roth conversions. That way, like I said, number 4, use Roth conversions strategically. It's not a transaction. They're a tax reduction tool. 5, consider how temporary deductions affect your long-term decisions. Like, for example, the enhanced senior deduction is temporary. Your tax liability is not. So make sure that we use that very wisely. And of course, coordinate taxes, investments, and retirement income together. They're not separate buckets. They're the same plan. So in closing, your 401k is a great tool, but it's also a complex tax machine that needs attention, planning, and accuracy. Avoid the traps, review the numbers, ask great questions, and make sure the IRS doesn't get more than they're entitled to. Thank you guys for listening. Subscribe to the channel. Go and get my book, MLB to CFP, live on Apple and Amazon. You have any questions, comments, concerns, you can email us at info@99capitalgroup.com. Send us your questions. Go to the website at www.99capitalgroup.com. Schedule an appointment. As you know, we're here to do what? Educate, empower, engage, and also entertain. Follow us on all social media channels at 99cap or at MLB to CFP. And also subscribe to the Substack. Now what? Guys, the 401k is powerful. Everything works as long as you understand the use case for it. Thank you guys for listening. Stay humble, stay safe, my friends. I'll see you again soon.